Hey, welcome back to the What the Wealthy Do podcast, where we break down the money moves the wealthy make and show you how to apply those same or similar strategies on your own personal wealth building journey. I am your host, Stephanie Dorsey, the CEO and co-founder of Margins Capital, an investment firm focused on providing women and people of color and access to an institutional quality portfolio of alternative investments. Okay, so today, y'all, we are going to continue our conversation about bonds. Last week we covered the basics, what they are, how they work, and why the most sophisticated investors never ignore them. And in case you forgot, bonds are simply loans. They're little bitty loans that we get to make to corporations and or governments. And so today we're going to go a little bit deeper and to talk a little bit about how they actually behave in the real world. Because here's the thing, bonds don't exist in a vacuum. I mean, they respond to what's happening in the economy and what the Federal Reserve is doing and what risks are present in the market. And if you understand these relationships, then you can predict how bonds will perform, and then ultimately how stocks will perform, and you will be able to protect your portfolio during very turbulent and or volatile times, and you'll be able to make smarter investment decisions. So before we get into it, y'all know the drill. This podcast is intended to provide financial education and not financial advice. Okay, so let's start. First things first. We're going to talk about one of the most important relationships in finance, and that is bonds and interest rates. So the single most important concept that you need to know about bonds is that bond prices and interest rates move in opposite directions. When interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. And so why? I know you're like, why? I don't get it. Why? Let me explain with an example. So let's say you buy a 5-year, $10,000 bond from Apple, and it pays a 5% coupon rate. So that means you get $500 every year for 5 years. And at the end of that 5th year, you're going to get your $10,000 back, right? We like it. It's predictable. It's cute, right? All right. But let's just say that after you bought the bond, the interest rates go up. And so new bonds, like people can buy a bond from Microsoft that for $10,000 for 5 years, it has a 7% coupon rate. And so that means every year for 5 years, it's getting $700, which is more than your $500. So clearly your Apple bond is less cute, right? It's not as attractive because you're only getting $500 a year, where Microsoft, if you buy that bond, you'll get $700 a year. So if you were to sell your Apple bond on the secondary market before it matures, nobody's going to pay you $10,000 for it, right? Because why would they? They can go and spend $10,000 and get a Microsoft bond and get 7% instead of your 5%. So in order for you to sell your bond, you'd have to discount the price. Maybe you could sell it for $9,000 or $8,500, and that's a loss. All because interest rates went up and it made the value of your Apple bond go down. So let's flip it. Let's say interest rates drop. And so now Microsoft is selling its bond at a 3% coupon rate, right? So now new bonds are only paying $300 a year for 5 years, and your bond is still paying $500 a year. And so now she looks better, right? She's cuter. And if you want to sell your bond, you'll be like, you got to pay me a little bit more for it, right? And investors will be willing to pay you $11,000 or $12,000 because your bond is paying a 5% coupon rate, and on the market today, they could only get 3%, right? So why is this the case? It's because when you buy a bond, you are buying a loan agreement for a given period with the original loan terms. So when the interest rate goes up or down, the new interest rate is compared to the bond terms that were originally issued on your bond. And so even if you buy it when it's first issued, or if you buy it on the secondary market, you are buying the entire loan with those original terms. Just our key takeaway though, hopefully you understood all of that. The rising interest rates equals falling bond prices, and that losses if you sell early, falling interest rates mean rising bond prices and gains if you sell early. Now, here's the key. If you hold on to your bond to maturity, you still get your full $10,000 back, right? So, assuming obviously the company doesn't default. So the price fluctuations only matter if you need to sell your bond before it matures. And this is why bond investors obsess over what the Federal Reserve is doing with interest rates, because the Fed controls short-term interest rates, and that ripples through the entire bond market. Okay. All right, so let's talk about the Federal Reserve and why they're doing certain things with the interest rates that are in fact impacting bond prices. And so the Federal Reserve is the central bank of the United States, and one of their main jobs is to control interest rates in order to manage the economy, right? And so if the economy is overheating, meaning there's too much growth, there's rising inflation, the Fed will raise the interest rates to cool things down. All right. So in other words, the market is considered hot when demand outpaces supply. And so when that happens, companies are like, back then you didn't want me. Now I'm hot. You all on me. Let me raise these prices because I can get more for this same good. Right. And that means inflation. And so when there's too much inflation, the Fed will come in and raise interest rates to cool things down. Why? Because higher interest rates makes borrowing more expensive, and businesses borrow less, consumers spend less, and economic activity across the board just slows down. So they're cooling the inflation, right? And what happens to bonds? We know that interest rates are up, so bond prices are going down. They're going to lose their value because we just talked about that. All right. Alternatively, when the economy is already really, really cool, so the Fed will lower interest rates to stimulate the economy. So what does that mean? The market is considered cool when supply outpaces demand. People are holding on to their paychecks a little longer. We got all these goods and ain't nobody buying. And when that happens, customers aren't spending money for whatever reason, and companies have extra inventory. And so when supply is higher than demand, the Fed will lower interest rates to stimulate spending. Lower interest rates means borrowing gets cheaper, businesses invest more, consumers spend more, economic activity picks up. And again, what happens to bonds? They've lowered the interest rate, so we know the prices of bonds or the value of bonds are going to go up. Bonds are becoming more valuable. And so let's do a real world example. So let's think back in 2022, inflation hit 9%, like hit an all-time high, the highest in like 40 years. And so the Fed responded very aggressively by raising interest rates from near zero to 5% in just 18 months. And what happened? All those bonds, the value of bonds went down because interest rates went up. But not only did they go down, they crashed, right? The bond market had one of its worst years in history. And some bond funds lost like 15 and 20% of their value. Why? Because new bonds were being issued in the market with much higher interest rates. And so the coupon rates were higher, and it made the old bonds with lower coupon rates have lower value. So investors who didn't understand this got crushed, right? But investors who did understand this, they either held their bonds to maturity to avoid loss because they're going to get their money back, or they waited for rates to peak and then they bought bonds at a discount, locking in higher yields, and that offset their portfolio's returns. And so sophisticated investors know how to navigate this. And I'm using the term sophisticated investors and not the wealthy here intentionally, right? Because we're talking about, if you're not an institutional bond trader, you might not really understand this. And I would venture to guess 95, 97, maybe 99% of people don't really understand these relationships and how things work. And because you listen to this podcast, you do. Good job for you. Okay. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. Just 20 seats. 20. Learn more at joinsovereign.co. And remember, you are always wealthy. All right. The second big topic I want to talk about in this episode is the yield curve. And the yield curve is the bond market's crystal ball. And it's basically a very powerful tool in predicting recessions, right? And so the yield curve is a graph that shows the interest rates or yields of bonds with different maturity rates. Before we go further, I want to clear up a common misconception. So the yield curve is not a tally of all the bonds out there in the market and their current coupon rates, right? That's not what it is. Bonds issued years ago have fixed coupon rates that never change. A bond issued in 2020 at 2% will always pay a 2% coupon rate of the face value, right? It will always do that. So the yield curve doesn't plot coupon rates. What it does is it plots what those bonds would yield today based on the current market price. But not what happened in 2020. They're looking at in May 2026, if we bought this bond, what would it be worth in terms of yield today? So let me break it down a little bit more. So let's just think if interest rates, and we know interest rates have gone up since 2020. So that old 2% bond is now trading at a discount. And so you could buy it for less than the face value, which means your effective yield is higher than 2%. Maybe it's like 4% because you're buying at a discount, right? So you're getting $10,000, but you're only paying $8,500 for it. And so today that would show up on the yield curve as 4%, not the 2% coupon rate that was previously issued. So the yield is a combination of the coupon rate plus or minus in certain instances what you can actually get if you sold your bond or bought your bond today. So if the interest rates are higher than when you bought your bond, then your yield will be lower if you sold it. If the interest rates are lower when you bought your bond, you know the bond is valued higher, it's more valuable, and so your yield is going to be higher than your coupon rate if you sold your bond today. So the yield curve is always showing what return can I get today if I lend money for a certain amount of time based on this giving bond, right? It's always showing what the current market condition is, right? So a normal yield curve shows a healthy economy. It normally slopes up and to the right, because short-term bonds that are 1 to 2 years are going to have lower yields. Longer-term bonds that are 10 to 30 years are going to have higher yields because you are taking more of a risk by locking your money up for a longer time. So you get to demand higher returns. So like a 2-year treasury, maybe you're only going to get 3% for that. But a 30-year treasury, you're going to get 5% for that, right? Because your money is locked up for 30 years. This is normal, right? Longer term bonds pay more than shorter term bonds. However, what is not normal is if you have an inverted yield curve, meaning the shorter term bond is paying more interest than a longer term bond, right? And so, for instance, if you have a 2-year treasury that's paying 5% coupon rate and a 30-year treasury that's only paying 4% coupon rate, this is abnormal and it's a huge red flag. What is the red flag of? And recession. Because the market is betting that the Fed is going to cut rates in the future because a recession is coming. And so they're willing to accept lower yields on longer term bonds because they think rates will be even lower later. Okay, so an inverted yield curve has predicted every major recession in the last 50 years, usually 6 to 18 months before it happens. There was an inverted yield curve in 2006 before the Great Recession. There was an inverted yield curve in 2019 before the 2020 COVID crash. The sophisticated investors watch the yield curve obsessively because when it inverts, they start preparing. They start reducing their stock exposure. They start increasing their cash coffers. They start building safe haven assets. And so the bond market is often very smarter than the stock market because it sees trouble coming faster when the stock market sees it, and they price in risk a lot differently. So All right, y'all. I know that was a lot, but that concludes our episode today for part 2 of our bond series. We broke down how interest rates affect bond prices, and we talk about how the yield curve predicts how markets will perform in the future. So hopefully I explained it quite simply. These can very well be complex ideas, and the goal is to explain this in a way that you all can see, like, they just trying to make this stuff more complicated. It can be a little complicated, but it doesn't have to be, and it certainly is not beyond your capacity to understand it. So if you found this conversation helpful, please share it with a friend, and don't forget to like, follow, and subscribe wherever you get your podcasts, be it on Apple, Spotify, or YouTube. And we will see you next week, where we will continue our bond conversation, because you know what? We can do hard things. I ain't scared of this hard stuff. All right, bye.